The news alert blared across television screens and mobile devices, cutting through the usual hum of daily headlines. The urgency in the anchor's voice was unmistakable. Something big was happening, and it demanded everyone's attention. Major U.S. developer defaults on skyscraper loan. The headline was stark, almost surreal. For years, these developers had been the backbone of America's urban skylines, symbols of growth and prosperity. Now, one of the giants had stumbled. In downtown San Francisco, a once bustling glass tower now stood empty, its owner surrendering the keys to the bank. The building, once filled with the energy of thousands of workers, was now just a hollow shell, echoing with memories of better days. This wasn't just another business failure, it was a warning shot for the entire commercial real estate market. Financial analysts and investors watched nervously, realizing that this single event could signal deeper trouble ahead. The echoes of 2008 were unmistakable, raising urgent questions. Is this the first crack in a much larger dam? Memories of the last financial crisis resurfaced, as experts debated whether history was about to repeat itself. On the streets below, shuttered cafes and empty storefronts told the real story. Lost jobs, lost customers, and a city's ecosystem unraveling. Each closed sign represented a family, a dream put on hold, and a community struggling to adapt. Commercial real estate may seem distant, but its fate is tied to the health of the whole economy. When office towers go dark, the ripple effects are felt everywhere, from local businesses to national banks, from city budgets to retirement funds. The tower's failure forced a national reckoning. Could a collapse in commercial real estate drag down the rest of the economy? Pundits and policymakers scrambled to assess the risks, knowing that what happened in one city could soon spread across the country. The silence from those empty floors was a chilling answer. It was more than just a lack of activity, it was a warning, echoing through the halls of finance and government alike. The question now: who would be next, and how far would the damage reach? Commercial real estate, or CRE, is a $20 trillion pillar of the U.S. economy. It's not just a number. It represents the physical spaces where American business happens, from the tallest skyscrapers in our cities to the sprawling warehouses on the outskirts of town. CRE is woven into the fabric of daily life, shaping the skylines and communities across the nation. It's the backbone of business. Offices where ideas are born, warehouses that keep supply chains moving, malls and retail centers where people shop, and apartments that house millions. Hotels, hospitals, and even schools often fall under the CRE umbrella, touching nearly every aspect of American life. Millions of Americans depend on CRE for jobs, from construction crews raising new towers, to property managers keeping buildings running smoothly, to janitors, security staff, leasing agents, and maintenance workers. CRE supports a vast ecosystem of employment, both directly and indirectly. When CRE thrives, communities flourish, main streets buzz with activity, new developments bring fresh opportunities, and neighborhoods grow stronger. But when it falters, the effects ripple everywhere. Empty storefronts, declining property values, and lost jobs can quickly follow. Banks, insurers, and pension funds all rely on CRE as a stable asset. These institutions invest billions in commercial properties, counting on their steady returns to fund loans, pay out insurance claims, and secure retirements for millions of Americans. The value of these properties underpins local banks' ability to lend. When CRE values are strong, banks can confidently extend credit to families and small businesses, fueling further economic growth and opportunity. Cracks in this foundation threaten jobs, bank stability, and economic growth. When commercial properties lose value or sit empty, it can trigger layoffs, loan defaults, and even financial crises that reach far beyond real estate. The health of CRE is a barometer for the entire economy. Economists, investors, and policymakers watch it closely, knowing that shifts in this sector can signal broader changes ahead. Right now, that barometer is flashing storm warnings. Rising vacancies, falling property values, and economic uncertainty are putting pressure on this once solid foundation, raising urgent questions about what comes next for the American economy. CRE isn't one market. It's four: office, multifamily, retail, and other, industrial and hospitality. Office towers, once blue-chip investments, now struggle with vacancies. Multifamily apartments remains resilient, but faces rising costs. Retail is battered by e-commerce, with malls suffering most. Industrial properties, warehouses and logistics, are booming thanks to online shopping. Hospitality, after a pandemic collapse, is rebounding. Each sector faces unique pressures, but not all are hit equally. Understanding these pillars is key to grasping the crisis. The crisis boils down to this: property values are falling fast. Years of cheap money inflated prices, but the pandemic changed everything. Remote work slashed office demand. Online shopping gutted retail. Lower rents mean lower building values. Owners who borrowed heavily now owe more than their properties are worth, underwater and tempted to walk away. Rising interest rates make refinancing impossible, accelerating defaults. Each default sends shockwaves through banks and investors. The Great Devaluation is turning prized assets into liabilities. This isn't just a paper loss. It's a real threat to financial stability. The stage is set for a wave of defaults. High interest rates are pouring gasoline on the fire, intensifying the challenges already facing the commercial real estate market. What was once a manageable situation has now become a full-blown emergency for property owners and investors across the country. For years, cheap loans fueled CRE growth. Now, rates have doubled or tripled, making it far more expensive to borrow money. The days of easy credit are over, and the cost of debt is weighing heavily on everyone in the industry. Many owners who locked in low rates years ago are now facing a harsh reality as their loans come due. Owners face skyrocketing payments just as rental income collapses. With more businesses downsizing or closing, vacancies are rising, and landlords are struggling to fill empty spaces. The gap between what they owe and what they earn is growing wider by the month. Many can't refinance. Falling values and shrinking cash flow shut them out. Banks are tightening their lending standards, and properties that once seemed like safe bets are now too risky for new loans. Owners are left with few options as their financial lifelines disappear. The result: a vicious cycle of defaults and falling prices. As more properties go into default, values drop even further, making it harder for others to refinance or sell. The entire market is caught in a downward spiral that's hard to escape. The market is frozen. Buyers and sellers can't agree on price. With so much uncertainty, deals are stalling, and transactions have slowed to a crawl. No one wants to buy at today's prices, fearing they'll fall even more tomorrow. The Fed's fight against inflation is squeezing property owners to the breaking point. As interest rates rise to combat inflation, the pressure on landlords and investors only increases, leaving many feeling trapped and desperate for relief. Refinancing is nearly impossible for many, forcing defaults. Owners who can't secure new loans are left with no choice but to walk away from their properties, leading to more foreclosures and abandoned buildings. This interest rate shock is turning a problem into a full-blown crisis. Experts warn that the ripple effects could spread beyond real estate, impacting banks, local economies, and even the broader financial system. The fallout is spreading fast, with more cities and communities feeling the impact every day. As vacancies rise and property values fall, the consequences of high interest rates are becoming impossible to ignore. The real danger may lie with America's small banks. Unlike Wall Street giants, regional banks are heavily exposed to CRE loans. As property values fall and defaults rise, these banks face mounting losses. A wave of bad loans could wipe out their capital, threatening their survival. These banks are vital for small business lending. If they fail, Main Street suffers. A CRE crisis could trigger a broader credit crunch, stalling the economy. The risk isn't just to banks, it's to every community they serve. Two forces drive the CRE crisis: remote work and e-commerce. The pandemic made hybrid work the norm, slashing office demand and spiking vacancies. Landlords offer desperate concessions, but many buildings are turning into ghost towers. Retail faces its own apocalypse. Online shopping has decimated malls and many brick-and-mortar stores. Some retail, like groceries, survives, but many properties are obsolete. Owners are stuck with assets built for a world that's disappearing. Converting offices or malls is costly and often unfeasible. The fundamental value of these buildings is in question. The maturity wall is approaching. $2.2 trillion in CRE loans come due by 2027. Normally, owners would refinance, but now falling values and high rates make that nearly impossible. Many properties are worth less than their debt, and new loans are far more expensive. Owners face tough choices: inject cash, sell at a loss, or default. Banks are less willing to extend and pretend. Each maturing loan is a potential default, threatening banks and investors. This slow-motion crisis will play out over years, building by building. The maturity wall will turn market fears into real losses. CRE troubles aren't just for developers and banks, they affect everyone. Defaults hurt small banks, choking off loans to local businesses and stalling job growth. Falling property values slash tax revenue, forcing cities to cut services or raise taxes. Urban decay and blight can follow, lowering quality of life. The health of our cities and communities is tied to these buildings. This isn't another 2008, but the risks are real and growing. How we handle the coming debt wall will shape the economy's future. We all live in the shadow of these buildings, and their cracks matter to us all.